Good morning, everybody. September 30th, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary. It is in presentation form designed to be used by both investors and financial advisors, each of whom are expected to make their own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, or a recommendation for the purchase or sale of any security. Everything is strictly for informational purposes. Investors are advised to consult their own advisors regarding the tax consequences of their investment activities. The views expressed herein are mine and mine alone, may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Let's get into it. We had another great week in equity prices, and it's easy to come to the conclusion we might be getting at least temporarily to an end. We had a big year in 2023, clearly a big year in 2024. I know it's not over yet. We've got an entire quarter left to go, the fourth quarter, but 21.5% on top of a 20% last year in the S&P 500. Participation from mid and small cap indices, participation big in international markets last week, led a lot by emerging, which was really led by China, and massive stimulus measures finally enacted over there. Whether or not that's just a quick market reaction that will settle down or not is yet to be seen. This morning, I'm looking at the China market. It's doing quite well. Fixed income markets mostly flat, but look at high yield. High yield is this indicator of the economy. Those credit spreads are very narrow, quite tight. The economy remains strong and resilient. The concern with a strong and resilient economy at a time when interest rates are being cut is that we could get a resurgence in inflation. And I'm going to touch on that later on in the presentation. But first, let's take a look at some of the economic data received last week. First, manufacturing. This is the flash reading for September because September's not over. We'll get the final reading later this week. But the flash reading from S&P on manufacturing says it went from 47.9, which is contraction, to 47, which is also contraction. Lowest reading since June of 23. That's over 1 year. New orders, lowest reading since December of 22. Clearly, the manufacturing sector has slowed, is slowing, is contracting. But remember, it's only 15% of the U.S. economy, so we need to look at it along with the services sector, which is a far bigger percentage of the U.S. economy. What was of concern to me in looking at the manufacturing report is that companies reported that prices received came in at almost 55. That means they're getting higher prices for their goods. That's inflation. And that the price of inputs was at a 1-year high. So the price of and that's a rate of change, was at a 1-year high, not just the all-time. Of course, it goes up over time. So this tells me that the Fed's view that inflation is on a glide path to their core PCE target of 2%. I'm concerned that that may not be the case. Moving on to services, as measured by S&P Global, also the flash reading, we maintain very high levels there. PMI fell from 55.7 to 55.4, right in line with the 55.2 expectation. That's a high reading for services. 20th straight month of growth in the services sector and expansion. Prices also rose again, not as fast as they did the prior month, but it was the highest reading since March, and employment continues to rise there. So the thought of we need to cut rates to get ahead of layoffs and employment issues, I think may have been a bit premature. Now, we got a couple of readings on confidence. We've got the University of Michigan as well as the Conference Board, which you see here. September, consumer confidence fell, a pretty big drop from 105.6 to 98.7. That was well below the estimate of 104. Largest decline in about 3 years. Present situation component fell substantially, 124.3, and expectations declined as well. So people are not particularly enthusiastic about the state of the economy, but the service sector is absolutely cranking. So it's the manufacturing sector, it's prices, it's affordability of homes, it's all of these things. And I think there's also election uncertainty comes into this as well. University of Michigan's reading on consumer sentiment bucked the trend and actually went a little higher. But you can still see here, really starting in about late 2020, consumers just haven't felt as good. We're way below the readings prior to 2020. We had low inflation. Obviously, prior to that time, we had the effects of massive amounts of fiscal and monetary stimulus in the economy. But in that reading, Michigan sentiment reading, current conditions rose a little bit and expectations rose, which was the opposite of what we saw from the conference board. Then we got a lot of data last week on residential real estate. It's a big part of everybody's balance sheet. FHFA house prices rose 0.1%. That was below the 2/10 estimate. That's probably a good thing. And home prices, according to this metric, up 4.5% on a year-over-year basis across the country. Case-Shiller, similar story, rose 27 basis points and up almost 6% on a year-over-year basis. Pending home sales rose 0.6% after falling big in July and are about 4.3% below where they were a year ago. A lot of this has to do with prices, availability, and rates. The fact that people are locked into low rates when interest rates were very low means very little supply is coming on the market. The fact that interest rates are higher today makes affordability more of a challenge. And so that limited supply coupled with affordability, pending home sales is not a robust report, and neither are new home sales. I guess neither is the new home sales number. August new home sales fell 4.7% after a big surge in July, but still way below those peak numbers of new home sales. Probably waiting for rates to come down. Weekly initial claims for unemployment remain very, very low. Came down from 222 to 218. Continuing claims, 1.83 up from 1.82. That's sort of right along in that very, very low and a very positive overall number. The biggest report, and there's a lot to unpack in the GDP report. This was second quarter GDP. So this is the quarter that ended in June, not the quarter that ends today. Today's September 30th, 2024. Second quarter was unchanged at 3%. So that was fine. But when you look through it, you go, okay, personal consumption down to 2.8, no big deal. First quarter GDP, which was a little soft, was actually revised higher. This kind of goes just a little bit in the face of the Fed saying, hey, the economy's weakening. We're revising prior quarters higher. And last quarter, we grew at 3%. And then they had all of the revisions that come as you get more data. This is a very normal thing to have revisions. From 2020 through 23, everything was revised higher due to stronger consumer and income and consumer spending. Only the first quarter of 22 experienced that negative GDP growth. If you remember, we said, we had this little recession because we had back-to-back negative quarters, but there was never an official declaration of a recession. It was just back-to-back negative GDP growth, which is a sort of an anecdotal definition, if that's such a thing. And now they say, well, we've actually revised that. There was only one negative quarter anyway. So there clearly was no recession. The economy remains somewhat strong. And then we move into durable goods orders. Durable goods orders were unchanged. The estimate was for minus 2.6. So no, it was not a massive jump. I wasn't looking at the fact that a zero is over here on the right side. Backing out transportation, they're up 0.5%. Capital goods orders rose 0.2 after falling 0.2 the prior month. Personal income and spending just humming right along, sign of a nice economy. Personal income rose 0.2%. Wages and salaries up 0.5 or 0.5%. Personal spending also up 0.2%. Now, the big thing we have to think about, and we're all thinking about all the time, is what's happening with inflation. The Fed measures inflation many, many ways, but the way in which they determine whether or not they're meeting their statutory mandate, they self-define it. That's okay. They self-define it with core PCE. That's the red line on your screen. They call price stability 2% core PCE inflation. I'd like to have it lower. I'd like it to be zero. I'd like to have our currency be super safe and super strong and super dependable. But deflating the value of your currency 2% every year has some advantages to a sovereign nation. They say the PCE index says that it rose 0.1% in the month of August and is up 2.2 from a year ago. That is your blue line. But your core PCE is up 2.7 from a year ago. And core, backing up food and energy, it moves more slowly. You can see the blue pulls it higher and the blue pulls it lower. They think the blue is going to continue to pull it lower, and it's going to get to that too. That's what they've been saying. That was the justification. Hey, we've got that, so we're going to go ahead and get ahead of jobs losses and slowing, pointing to the manufacturing sector, reasonable thing to do. And so we're going to start cutting interest rates. And in fact, we're not going to call it stimulative. We're going to say it's less restrictive. And that's a very reasonable statement to make as well. It's an argument that they've made. But when you look at the core PCE data on a month-over-month basis, the August number we just got last week, the one I just talked to you about, was up 0.13% on a year-over-year basis. So the August of 23 number that rolled off was 0.1. That's pretty close. Obviously, 0.13 is a little higher. So that number it actually ticked it up on a month-over-month basis. So what's about to happen when the September number rolls off? Now, the September number is 0.32, September of 23. As that rolls off, it's going to be replaced with something. So my question I want to know is, what will it do to core PCE? Well, even if it's a zero, and I don't think, certainly won't be negative. If it's a zero, core PCE is still above and significantly above the Fed's target rate. If it's 10 basis points, 245. You can see all the way down here. If it's 20 basis points, 256, 30 basis points, 266. So in my view, we haven't whipped inflation. What we're doing is we're sort of making assumptions that could be problematic for the U.S. economy. And no sooner did you think, okay, we got things going, okay, the inflation is going to move down, and now all of a sudden we're about to be hit with a very significant inflationary issue. The U.S. East Coast and Gulf states dock workers are preparing to strike, most likely tonight at midnight. A shutdown would hobble businesses and spike inflation for goods and imported food items. And as we move into the winter, many of our food items are imported from south of the equator, from South America. Asparagus, strawberries, fruits, you name it. So what can importers do? Well, they could switch to air for some perishable food items. Far more expensive mode of transportation to get your asparagus from South America to San Diego, and that will cause inflation. Rerouting to the West Coast, which is already at 80% of capacity, doesn't look like a very good option. One, even if they would take the ships, you have long ground transportation via rail or truck, also costing more, also inflationary. The unionized workers in California and Washington are unlikely to work on diverted ships out of solidarity with their union brothers and sisters in the East and the South. What about Canada and Mexico and trucking it? No, those ports just can't accommodate. They're just too small to accommodate the demand for the United States. Our good friends at JP Morgan said this morning they estimate the strike will cost our economy between about $4 to $4.5 billion a day. Where are the two sides? Well, the latest report is they're not talking, and they're set to strike tonight at midnight. Workers are looking for a 77% wage increase. That's inflationary. Over 6 years, and employers have offered an also inflationary 40% wage increase over that same 6-year period. So did the Fed know about this in advance? No, but this is the kind of thing that happens with economics, right? Things come up, and this is not good for prices. Okay, finally, this week we've got Chicago PMI this morning, and then we get the final readings from S&P, ISM on both manufacturing on Tuesday, services on Thursday, JOLTS or job openings, construction spending, auto sales, and then we get in. It's the first week of the month because it's October, and the first week of the quarter, we'll get a lot of reports. We'll get the ADP employment report saying we added hopefully 120,000 jobs, and the Bureau of Labor Statistics report saying we added 130,000 jobs. As always, you can find me on any podcast format with the audio version of this or on the YouTube channel. You get all the charts and graphs and get to see my pretty face. Thanks, everybody.